The Fed just held rates. Now you might be wondering, should we panic? If you completely missed what Powell actually said about when cuts are coming back in that 1 hour long speech, then I'm going to help explain and show you the exact timeline he gave us, hidden in plain sight. Look, if you're short on time or you just don't want to listen to some random guy on the internet talk about monetary policy for 10 minutes, here's your one takeaway. Powell essentially told us rate cuts are off the table until at least June or July of 2026. The Fed is waiting for tariff inflation to peak, which he expects around the middle of the year. Mark your calendar. That's it. That's the timeline. But if you want to understand why this matters for your portfolio and what Wall Street analysts are quietly repositioning for, stick around. So hey, for those who are new here, I'm DataCat, and yeah, I know, weird name. But hear me out. I spent some years as a very average analyst inside a Fortune 50 company, you know, the soul-crushing and daydreaming type. I was basically a corporate cat stuck in a cubicle, except without the naps. Cats get naps. I got 4 cups of coffee. About 6 months ago, I started this channel because I figured, hey, if I'm going to spend hours making money for corporate and eventually going to be replaced in the next wave of layoff anyway, might better off share what I find with people who actually want to hear it. And apparently some of you do, which is kind of wild to me. And just to be clear, I'm not here to sell you a course. I'm not going to pretend I've got some secret formula that'll make you rich. I'm just a guy, former corporate drone, who likes digging through data and explaining what I find. Think of me as that friend who actually reads the fine print so you don't have to. Except, you know, more caffeinated and with worse social skills. Anyway, if you find this useful, a like helps the channel more than you'd think. And subscribing means you won't miss when I drop the next one. Alright, enough about me. Let's talk about what Powell actually said just now. So on Wednesday, the FOMC voted unanimously to hold rates steady at 3.5 to 3.75%. Well, basically no surprise there, everyone expected it. But here's what most people glossed over. The Fed cut rates by 75 basis points back in late 2025. That's 3/4 point cuts. And now Powell basically said, quote, "We see the current stance of monetary policy as appropriate." In simple terms, the Fed is suggesting that the urgency to cut is gone. They think they've done enough to prevent a recession. For now. And I want you to notice something. He said they're bringing rates within a range of plausible estimates of neutral. That's Fed speak for, we're close to where we want to be. We're not in a rush anymore. So if you were expecting cuts in March or May, I've got bad news. Unless the labor market completely falls apart, and I mean crashes, not just softens, the Fed is going to sit on their hands. Now this is the part that most coverage missed, and frankly, it's the most important thing Powell said all night. He told us almost explicitly when rate cuts could resume, and it's tied entirely to tariffs. Here's the quote. "Once the effects of tariff increases have passed through, we are well positioned to determine the extent and timing of additional adjustments." He then said he expects tariff effects to peak in the, quote, middle quarters of the year. So let me connect the dots for you. Powell is saying, we're not cutting until we see tariff inflation roll over. He expects that to happen around June or July. The CME FedWatch tool, as of now, is pricing in a slightly higher probability of the first cut happening in July. That's not a coincidence. The market heard him. And then there's something else. Powell mentioned that the current rate is at the higher end of neutral. What does that mean? It means the destination for this entire cutting cycle is probably around 3%. That's only 2, maybe 3 cuts left. Total. So, if you're sitting there thinking we're going back to zero rates and easy money, I hate to be the bearer of bad news, but that cat has left the building. This isn't 2020. The Fed's ammunition is clearly limited for now. Alright, on the other hand, let's not forget that inflation is still running relatively hot, core PCE at 3%. Normally that would make the Fed extremely hawkish. They'd be talking about hikes, not cuts. But this time, Powell did something interesting. He essentially told us to ignore the headline number. Most of the overrun in goods prices is from tariffs. And that's actually good news, because if it weren't from tariffs, it might mean it's from demand. Let that sink in for a second. The Fed is looking at 3% inflation and calling it good news. Huh? Why? Because they're splitting inflation into 2 buckets. Goods inflation, which is artificially elevated by tariffs, and services inflation, which is actually cooling. Disinflation appears to be continuing in the services sector. So what does this mean for you? Well, if you see a hot CPI print in the coming months and it's driven by goods and tariffs, don't panic sell. The Fed has already told you they're going to look through it. They're treating tariff inflation as, yes, I'll say it, transitory. They didn't use that word this time, but that's exactly what they mean. It's like the Fed saw a mouse in the house and decided, it's not a rat. We'll let the cat handle it eventually. Except in this case, the cat is time, and the mouse is tariff-driven price hikes. And remember last year, a few months ago, the Fed was cutting rates because they were worried the job market was cracking. There was genuine fear of a recession. Well, Powell's tone has also completely shifted. He said, quote, indicators suggest that conditions may be stabilizing after a period of gradual softening. Unemployment is sitting at 4.4%. It's barely moved in months. But here's the nuance. Powell also pointed out that part of the reason job growth looks weak is because there are fewer workers available. Immigration restrictions have reduced labor supply. So it's not just that companies aren't hiring, it's that there aren't as many people to hire. That's a supply problem, not a demand problem. And the Fed knows the difference. Now this is actually, in a weird way, supportive of stocks. The Fed isn't panicking about jobs anymore. They're watching, but they're not scared. Now this part surprised me a bit. Powell explicitly credited the AI infrastructure boom for economic resilience again. He said, we're benefiting from the AI build-out of data centers. That's another thing we're benefiting from. He also hinted at something bigger, higher productivity and higher potential output. He is once again reiterating that the economy can grow faster without triggering inflation because technology is making us more efficient. That raises what economists call the speed limit of the economy. So if you're wondering why growth has been solid and inflation hasn't completely exploded, part of the answer is AI-driven productivity, and the Fed sees it, they're factoring it in. This is frankly a tailwind for tech and industrial stocks that are building out this infrastructure. Data centers, chips, power equipment. Powell basically name-dropped the thesis, saying that the AI bubble is not a thing, at least not for now. Alright, but I also have to mention this because it came up multiple times in the press conference, and Powell was unusually direct. There's a case involving Fed Governor Lisa Cook that's being viewed as a test of the Fed's independence, and Powell called it, quote, perhaps the most important legal case in the Fed's 113-year history. He also said, if people lose their faith that we're making decisions only on the basis of our assessment of what's best for everyone, it's going to be hard to retain it. That's a strong statement. Despite all the investigation and critics from Trump going on, Powell is still essentially telling the bond market, we are not going to cut rates just because politicians want us to. We are not going to monetize the debt. And why does this matter for you? Because if bond investors start believing the Fed is politically compromised, long-term rates will spike. Inflation expectations will become unanchored. And that's bad for everyone. Alright, let me give you the quick rundown on what this means for different asset classes. For stocks, I will say, cautiously bullish. We're back in the Goldilocks scenario. Solid growth, stable jobs, and a Fed that's willing to ignore tariff inflation. Tech and industrials tied to AI infrastructure look particularly well supported. The risk? If tariff price hikes trigger a wage price spiral, the Fed stays higher for longer. Now, Powell doubts this happens, but it's the tail risk to watch. Bonds, neutral to bearish on long duration. Powell admitted the fiscal path is, quote, uncontroversially on an unsustainable path. The Fed controls short-term rates, but long-term bonds, your 10-year, your 30-year, those could face pressure from deficits and inflation volatility. Expect the yield curve to stay relatively flat. And a special mention, the dollar remains volatile, since Powell refused to comment on the recent dollar weakness, deferring to Treasury. A pause in rate cuts usually supports the currency, but fiscal concerns and political noise could still weigh on it. So look, I'm still waiting on more earnings to come for the rest of the week, so I'm not going to do a detailed technical analysis just yet. But on hindsight, the market looks healthy. The Fed gave us exactly what we needed, clarity on the timeline and a willingness to be patient. If you made it this far, thank you, seriously. I know there are 1,000 other things you could be doing right now, and you chose to listen to my boring voice rambling about monetary policy. I appreciate it more than you know. If you found this useful, hit the like button. It helps more than you'd think for a small channel like this. And if you want to catch the next breakdown, subscribe. And remember, even the Fed is just guessing. They're just guessing with better data. Alright, DataCat out, and I'll see you in the next one.